Well, a warm welcome, everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial. Today we have Sequeira from Australian Eagle Asset Management. Sean is a Chief Investment Officer and co-founder of the company with over 30 years of experience in financial markets. He leads the investment team and chairs key committees. Sean began his career in Europe before moving to Australian equities in 1999. He's a CFA charter holder with a business degree from UTS and regularly contributes to financial media. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through our discussion today, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own financial objectives, financial situations or needs, so it's not a recommendation. It's important if you consider what we discuss is appropriate for you before acting upon it. Please also refer to any product disclosure statement before making any investment decisions. Details of this general advice warning can be found at the moneysmart.gov.au website. Thanks for joining me today, Sean. It's been 12 months since our last vlog, and a lot's happened in that time. There's been US elections, global trade tensions, 2 ongoing conflicts in the Ukraine and the Middle East. No doubt you'll have some valuable insights to share, particularly from Australian Eagle's perspective. Now, to kick things off as a fund manager specialising in Australian equities, can you talk us through Australian Eagle's history and investment philosophy?
Yeah, well, we've been managing money for 20 odd years, and in that time we've been able to develop a process that looks through multiple market cycles and multiple events. You know, we've had wars, we've had crashes in markets, we've had economic ups and downs. You need a process that can guide you through all of those things. And that process involves identifying quality. And importantly, from our perspective, not just quality in the 5 key areas of what a good business is, which is, you know, do you have a competitive advantage? Are you in a growing market? Has management shown a history of being able to take advantage of those 2 things? Do you have a balance sheet that can actually support your strategy without taking on too much risk? And are you minority shareholder centric in your capital allocation decisions? They're 5 key areas of quality. And you'll note, I didn't say anything about what sort of accounting metrics do we have as a minimum. This is just qualitative, fundamental business analysis.
Okay.
And we rate those things. And in doing so, we're able to look at the market through cycles, through the ups and downs, the noise that's happening at the moment, and try and look a little bit further forward. In doing so, we rate that quality and try and identify inflection points in that. And then you can get a really good potential for upside for a stock.
So how do you go through that investment process? Can you elaborate a bit more on what you guys do?
Yeah, so what we'll do is we'll rate, we tend to be more large cap focused. So we will rate companies, the top 100 plus another 30, 40 stocks that we're looking at, that we're interested in. And we will rate those companies from a qualitative perspective. We've got 10 qualitative factors that cover those key areas that I mentioned earlier. And that rating allows us to view all of those stocks, all the 130, 140 stocks that we're looking at on the same plane. And then we can identify which ones that we would like to enter into based upon their quality, and more importantly, which ones are improving their qualitative stance.
Okay. Well, how do you approach risk management, especially given we've got a volatile global backdrop? You're specialising in Australian equities. Some of that volatility flows through to the Australian market.
Yeah, so in terms of risk management, it's what we tend to find in the market is that you can have stocks or whole sectors moving up for reasons that you can't predict. Something will happen overseas and that whole sector will move. Consequently, we tend to have a broad sectoral spread of stocks across multiple different areas of the economy. And that way, if something happens in some sector, we have got other sectors that might be moving up or can offset those changes that are occurring. The other thing is that if you do have a minimum level of quality for the individual stock, worst case scenario is that you've got a high quality asset that someone will want. And that is from a fundamental business perspective, at least you've got some downside protection there. And that, along with the spread of stocks, will give you a good range of potential outcomes, positive outcomes, and trying to minimize that downside risk.
Okay. Well, what are the key opportunities and risks that you're seeing in the Australian market at the moment, and how's it impacting the portfolio?
So some of the key opportunities that we have seen, and we've started to, over the last 6 months, we've started to focus in, we would say, what are strategic assets in this market. And strategic assets might be different things for different companies, different sectors. It's very simple at the moment with the geopolitical issues that are going on. You mentioned wars earlier. There's actually this polarization in the world that's occurring, and you can say Trump's part of that. He's actually identified it, I suppose, in terms of saying we need certain assets. Now, those strategic assets in the resources space are showing potential. We're seeing the rare earths, we're seeing things in uranium, we're seeing opportunities in copper, in iron ore. They're strategic assets. For a resources company, a strategic asset is a world-class asset that has multiple decades of potential production, lowest cost quartile. They're strategic assets. And obviously needed in our transitioning world. The other thing is that if a company can build a platform that is needed, you will see this in the tech industry. We see it in the healthcare industry. Those are strategic assets. And obviously beyond that, you have assets which are highly regulated and very, very difficult to enter those markets. Those are strategic assets. That gives you good downside protection.
Okay. So elaborating a bit more, how does Australian Eagle differentiate itself from other fund managers in this space? And what would you say is your greatest strength as a fund manager?
So I suppose I did allude to this earlier in terms of our differentiation, and I do focus and I do harp upon this. Our competitive advantage is focusing in upon that change, not just buying stocks that are cheap. We buy stocks that we believe has good potential upside based upon their high levels of quality, but are changing. They're running through this inflection point, this hopefully the bottom end of that inflection point that potentially sees positive change in their operating environment, in their the way that they operate in their environment, and that way they can attain outsized returns versus their competitors, and that's we believe is our key competitive advantage in the market.
Okay. Well, can you share an example of a time when Australian Eagles experienced a challenging period and how you navigated through it to turn the performance of the fund around?
Well, we can say that we've had a couple, particularly over the last little while, a couple of periods where we've underperformed the market. The most recent one was the extreme volatility that we had in August, the August reporting season. There were a couple of stocks where the outlook for the stock didn't change too much, but the market really hurt the company to an outsized extent. In the way that we look at stocks, we tend to look more medium term. Our medium term outlook will determine whether we like the stock or not. And in doing so, we're able to avoid the noise that occurred during that period. Yes, we did underperform, but in looking a little bit further out, having a little bit more conviction in the things that we were seeing emerging, like those strategic assets, particularly in the resources space, allowed us to actually continue to take good positions in those stocks and start to move out of that underperforming period and actually start to outperform, particularly over the last couple of months.
Okay. So you've elaborated a bit on resource sector at the moment. And are there any other areas that you're sort of looking at or sort of reducing the exposure to recently? And can you elaborate a bit more on the reasons why?
Yeah, so over the last 20 years, we have seen a strong outperformance in the healthcare industry. No matter what it was, what was in that healthcare industry, you've seen a strong outperformance. Now, changes in regulation, changes in growth rates, changes in funding, all of those things are starting to actually weigh upon that healthcare sector. And we've been actively reducing that sector, maybe replacing it with not only, as mentioned, resources, but in actual fact, we've been replacing with certain areas of the tech sector, certain companies that have built platforms. I mentioned platforms as a strategic asset. They've built these platforms that we think create potential for significant growth, as well as minimal downside for the companies in terms of operations. Now, they're highly valued, so we'll watch very carefully as to how they execute and how we position the portfolio based upon that execution. But from our perspective, we think that might be the area that will take over the healthcare sector.
I've heard a number of international managers say the same thing about the US healthcare sector, especially with the current administration and some of the policies they're bringing into play. Now, how do you and your team stay ahead of market trends and maintain conviction in your investment decisions?
I must say that staying ahead of market trends, it would be to try and actually forecast what the market would love. The easiest way to do that is look at what the market's hating right now. And that would be an easy way to say, look, they will love this at some point in time. We tend to look from a bottom-up perspective and say, look, does this company have a quality asset? And what do they need to do to have that quality asset come to the fore, have the market recognize it? You might have a quality asset, but if the market doesn't recognize it, you won't have any change in share price. What we want to do is identify the quality asset, particularly if it's in an unloved area, and then say, okay, if the company is doing something to extract the attention on this asset, then that will be valued at a much higher valuation in the future. And if we can identify the things that they are doing and then confirm that they're actually doing it, then we can have confidence that that extraction of value will start to come to the market's attention very, very soon.
In your view, what makes a great portfolio manager in today's environment?
Well, firstly is to try and look through the noise. There's a lot of noise. It's easy to get caught up, particularly when things aren't going your way. It's easy to get caught up in the emotion of it all. Try and remove that. It's very, very difficult. I get emotional, but when you are emotional, try and remove yourself from making silly decisions. Look a little bit further forward. Try and remove yourself from the scrum and be a little bit humble. You can be wrong. As soon as you recognize that you're wrong, you got to take action. And that humility allows you to recognize when you are wrong. And you must be able to, on contrary to being humble, you also have to recognize when things are going your way, what level of conviction you're willing to take. When you're starting to see things changing, particularly companies changing in the manner that you expect, that's the time to have a little bit more conviction. And that conviction allows you to make your returns. So there is a very, very fine line between having that conviction and then also admitting that, hang on, I can be wrong here. And this thing is not working out the way I thought. The things that they said are not in the manner that I thought. We have to actually exit. And even if the stock price continues to go up, as long as you actually focus in on the reasons why you're in the stock, you know why you get out. And that's very important. That's how we manage our emotions, by focusing in upon that particular thing.
Okay. So Sean, we've covered a lot of ground in this conversation. Is there anything else you'd like to explain to our viewers today?
The only thing that I would like to say is that if it's easy for a investor to get caught up in the short-term movements and gyrations of markets, over the medium to longer term are the time frames that you should be focusing in upon, and that allows you to actually have a little bit more comfort with all the volatility that's taking place right now. It will pass, and we will have trending markets again. We have overall the market's trended pretty well, but we've had a lot of disruption in that trend. So by looking a little bit further forward, you can actually have a little bit more comfort.
Okay. Well, Sean, I appreciate you making the time to speak with us today.
Thank you very much.
Thanks for your time today, Sean. And if you'd like to talk to Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out to me and contact me via our website or give our office a call to schedule an appointment.